All right, yield nerds, there I am with my tariff bucket for Canada and Mexico in front of the stock exchange. And I am going to talk to you about how I believe one can trade smartly with tariffs on the horizon, potentially. Let me get started. We are at 458 subscribers. Thank you for your support. There are three playlists. If you're new to the show, please consider using the Income Investing Roadmap. And there are a couple of others, one on preferred stocks and the other one on looking at fixed income options across various durations called the Yield Super Bowl. And most importantly, make sure you do not follow me blindly. Do your own due diligence because I've made plenty of mistakes, and I'll tell you about a whopper of a mistake I made last week as we proceed. Well, the show has been organized as usual into four parts. First is on the temperature of the market. I will compare my performance with the NASDAQ, which is the most successful index in the market, at least in the last decade or so. And then we'll talk about what's coming in the next 2 weeks, or what everyone believes is coming in the next 2 weeks, tariffs, and my investment thesis based on tariffs and how things worked out. Well, first of all, I would tell you with great humility that the month of January has been very kind to me. My equity portfolio was up by 5.5%. You can see that while the rest of the portfolio, NASDAQ in particular, while NASDAQ remained flat or slightly down, I jumped. And the day of the big scare, where the NASDAQ dropped by 3.5, 4 points, my portfolio did drop, but I loaded up on stocks. And when things came back, I vaulted way ahead of the NASDAQ. That was my little secret, and it worked out very well for me. And, on a on a much longer basis, on a 90-day basis, I once again am well ahead of the NASDAQ. So I hope to keep that lead and I hope to finish ahead of the index. But I'm not going to keep that as my competition. I'm going to think about the smart thing to do. And if that beats the NASDAQ, how wonderful. Well, some of you know, if you're not new to the show, you know that my entire portfolio is predominantly fixed income. That's why if you look at a longer time period, it just looks like a straight line. But if you look just in January, a fixed income portfolio with 10%, somewhere around 10% of longer term bonds is getting hurt. My growth has stagnated, it's barely 0.3%. So the lesson I'm taking is I'm not buying too many long duration bonds yet. There will be a time to buy. I will hopefully learn what it is and anticipate it, but now is not the time. I'm keeping everything I have on the long end, but it is decreasing my returns. But in reality, I don't intend to sell any of the long-term bonds, but it does look a little ominous with bear steepening on the long side. Well, let's talk about the next 2 weeks as I built my beautiful toll booth in front of the stock exchange. And the main thing I want to reiterate, I'm not a wealth management advisor. What I'm about to share is not investment advice or tax advice. I don't do politics. I'm here to make a buck trading equities and fixed income. And I'm sharing my lessons, and you do you. Hey, last week, Chairman Powell did not change the interest rates, and the market predicted that he would not. So there really was no surprise. There wasn't a magical crash, which was good. And now we hear a lot of rumblings about tariffs coming in very short order. And that is where there is a link I will post in the description, which talks about what could that do? What sectors will it hit? And you see a whole bunch of passenger cars in the illustration. And we're going to zone in on that as something that, if you are very heavy into US auto manufacturers, you may want to rethink. So what are the sectors where it'll go on the downside? Most likely on the discretionary side, industrials. There may be a short term, possibly medium term. I don't know much about the long term, but there could be a short term upside on the industrial sectors. Tech and healthcare don't really rely a lot on production in Canada or Mexico. They don't work with raw materials there. And so that might be something money moves towards. Pharma also has a big opportunity to be seen as the defensive sector, and communication services is a new one. This is AT&T, Verizon, things like that. There is really no tariff on making a long distance call, And if there is a very easy counteraction there. So those are likely to be seen as more domestic businesses immune from tariffs. So how do we prove that to ourselves? If you look at, and I'll post a link to this article, this is the trade balance between the US and Mexico. If you look at what we get from Mexico, guess what? Passenger cars are the number one item in terms of value that come from Mexico into the US. Electronic equipment, nuclear reactors, they are big, machinery is big. However, within reason, I would argue, it's very hard to, if you put a tariff on machinery, it's going to come straight to the consumer. And if you need a lawnmower, you need a lawnmower. You're not going to pick the grass by yourself. Some of the resistance to price increases here could be possibly muted. The place where I see a lot of problems in terms of customers saying, I don't really need that, is do I really need yet another piece of furniture? Maybe I'm going to cut down on that. Maybe I'm going to drink cheaper beer. Or maybe I'm not going to eat this fruit and I'll eat that other fruit and so on. So those are the discretionary items with a lot of substitutes. And so if there were tariffs and those tariffs resulted in an increase in prices, customer behavior will shift more so in areas where there are active substitutes. And so that is one thing in terms of things coming from Mexico into the US. What about the opposite direction? Now, why should we worry about the opposite direction? If you are the Mexican government, you want to protect your home state, you're going to say, well, you tax lemons, I'm going to tax, and they're going to look at what they can tax. The reason you see electronic equipment both in the left and the right of the ledger, so to speak, is because things move back and forth across the border. And so that may be a really poor place for Mexico to start with counter tariffs. But yet again, vehicles is another one that gets caught in the crosshairs. Plastics get caught in the crosshairs. And you can see that the US isn't really shipping eggs, hint, hint, hint. The US isn't shipping some of the things such as drugs. They don't show up here. Those are not in this area. And so I pay attention to what is not there as much as what is there. There is no military manufacturer with a lot of trade going into Mexico. There is no utility company that supplies Mexico with power. There is no food company going in the other direction. So those, I would imagine, are somewhat protected. Let's look at Canada. Well, coming from Canada to the US, the items look eerily similar, except a couple of differences like furniture and nuts and fruits and that sort of thing. What about items going from the US to Canada? Once again, pretty much same old, same old. And what that tells me yet again is the defensive sectors, the pharma, food, utilities, war-related things are indeed not in the top places where if you are the other nation, you're going to look for counter tariffs. With that informing my thesis, as I stand in the toll booth watching American cars getting tariffed, here is what I am doing. I am loading up on stocks that still don't have a lot of debt. They still need to have all the value propositions. You can't just, at least I don't, just buy up a stock because it belongs in the right sector. I look at stocks that have a very local supply chain, things that are mostly sold within the US, produced in the US. I look at industrials, but not cars, and start thinking through what do I want to buy, pharma, war stocks, and those are areas where I think the market is going to go to. And so I, over the last week, sold off a bunch of equities, even though that wasn't at a huge gain. As a matter of fact, on a gain-loss basis last week, I was kind of at a net zero. I took a couple of doozies out and sold a whole bunch of small ones. And so here is where I'm left in terms of my holdings. My equity allocation did not really change materially. I went from 2.54% to 2.68%, whoop-de-doo, but my sectors changed a lot. I am very heavy, and when I say very heavy, I'm 5 times what the quote balanced portfolio ought to be in consumer staples and healthcare. That is because I believe, in my humble opinion, they are protected from tariffs. War stocks are another one where there is really no bilateral trade. And I am calling out the AI head fake, so to speak, where China announces a model and all of a sudden we are pretending as though we will not build one more data center. And so I am loading up more tech stocks. So what are some examples? Well, on the AI side, I'm still buying Arista Networks. Constellation Energy is somebody that has a lot of contracts to sell power to data centers. Baker Hughes constructs data centers. Meta, Nvidia, Oklo makes small nuclear reactors for data centers. Snips, Snips is also in the industry servicing the AI folks. I did screw up big time. If you watched the previous episode, you will know that I bought 10 pharma stocks. 9 of them are doing well. Veru disappointed me. I was down 40% and I took it on the chin. Thankfully, I didn't put a big allocation, but that was one of the mistakes I made. In terms of war stocks, I am loading up more and more on Curtiss-Wright, CW. GD is a new one. Katos does drones. And in new sectors, this is one I'm looking at the defensive sector. On the communication side, I bought a bunch of Verizon. And PL Planet Labs is another space sector, which really has nothing to do with inflation or tariffs. It's something that if a country needs launch services for their communication, they're just going to buy, and they signed long-term contracts with several companies and countries. So where am I in terms of equities? None of these should be a surprise. Here is Baker Hughes and Constellation Energy that are at the sub 5% gains, Planet Labs. And in terms of the middle of the pack, I have Raytheon, which is another war stock that I bought, General Dynamics. You see the same old, a whole bunch of pharma stocks and Curtiss-Wright. I do have some dogs, and one of them is Moderna. I expect Moderna to pick up hopefully next week. We'll see where that goes. United Therapeutics is also a pharma stock that I expect to pick up, and Regeneron, another pharma stock. So I'm hoping that I'm right on some of these where I've taken short-term losses. Who knows? We will wait and see. Thank you for listening to Yield Nerd, and I hope you are doing smart trades as we anticipate the next couple of weeks. Keep in touch. Have a good day.